What is going on, crypto fanatics, and welcome back to Bitcoin Bulletin, the only place on the internet where the hype is real and the news is even realer. The market is absolutely electric, folks, and if you thought things were moving fast before, buckle up, because this week is serving up some jaw-dropping developments that you absolutely cannot afford to miss. We're talking about the big players making massive moves, shifts in how we get paid, and even some serious legal drama unfolding in the crypto space. Get ready, because you're about to get the inside scoop on everything that matters, delivered with the energy you expect. Let's dive straight into the action. First up, is Bitcoin still a bargain? We're breaking down the latest strategy from a titan of the industry and exploring what it means for the future of crypto payments. This is one for the history books, so stay locked in. Then, we're hitting you with some mind-blowing numbers. Institutions are gobbling up Bitcoin at an insane rate, leaving miners in the dust. We've got the data that shows just how much demand is surging, and it's a story of supply and demand you won't want to miss. Next, we're looking ahead to next year and what could be a massive breakout for altcoins, all set against the backdrop of major institutional shifts following the Bitcoin halving. This is your strategic guide to what's hot and what's next. And finally, we're heading to India, where a major Bitcoin extortion case has just seen a shocking conclusion with life sentences handed down. This is a deep dive into corruption, crime, and the high stakes of digital assets. You won't believe the details. Stick around, because this is Bitcoin Bulletin, and we're about to break it all down. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss a moment of the action. Is Bitcoin still a bargain? In a financial world constantly on the move, where digital assets are reshaping economies, the question of Bitcoin's true value is always at the forefront. Michael Saylor, a prominent figure and executive chairman of strategy, has once again made waves by asserting that Bitcoin remains significantly undervalued. For those tracking the market, Saylor's pronouncements carry immense weight, especially considering his company's status as one of the largest corporate holders of Bitcoin. His recent acquisition of over 3,000 BTC only amplifies the importance of his perspective. But what does this mean for the broader cryptocurrency ecosystem and the companies navigating its complexities? Saylor has long championed Bitcoin as the future of value, often drawing parallels to digital gold. His current stance, suggesting Bitcoin is on sale, indicates a strong conviction in its long-term appreciation potential, even at current market prices. This isn't just a casual observation. It's rooted in strategy's well-defined and aggressive Bitcoin acquisition strategy. This approach has positioned strategy at the pinnacle of corporate Bitcoin adoption, and Saylor's public statements are keenly watched by institutional investors and other corporations considering similar moves. Strategy's latest purchase of 3,081 BTC, amounting to approximately $356.9 million, brings their total holdings to an astounding 632,000 BTC, valued at around $70 billion. This significant accumulation reaffirms Strategy's leadership in the crypto asset space and underscores their strategic decision to treat Bitcoin as a core treasury asset. Their continued commitment to acquiring Bitcoin, even amidst market fluctuations, signals an unwavering belief in its intrinsic value. However, the critical question remains: is such a concentrated, aggressive accumulation strategy sustainable and wise, given the inherent risks associated with Bitcoin investments? Strategy has indeed faced its share of legal challenges, including a shareholder lawsuit that alleged misleading communications regarding its Bitcoin holdings. Fortunately, the company recently secured a significant legal victory, with the lawsuit being dismissed with prejudice. This outcome is crucial, as it not only restores confidence in Strategy's operations, but also shines a light on the ongoing need for transparency and robust communication in the rapidly evolving cryptocurrency landscape. It serves as a potent reminder for all companies venturing into digital assets. Meticulous legal counsel and clear, honest communication are paramount. While the allure of substantial gains through aggressive accumulation is undeniable, the associated risks are equally significant. Bitcoin's notorious price volatility can create substantial uncertainty, posing challenges for financial planning and liquidity management. Furthermore, the regulatory environment is in constant flux, with new frameworks like Europe's MiCA imposing compliance requirements and costs. The ever-present threats of hacking and theft also demand constant vigilance. Companies must meticulously weigh the potential upside of Bitcoin against these multifaceted risks, ensuring that comprehensive risk management strategies are firmly in place. In response to Bitcoin's price unpredictability, the adoption of stablecoins for employee salaries is emerging as a practical solution. These stablecoins, pegged to stable fiat currencies, provide employees with a predictable and consistent salary value, shielding them from Bitcoin's price swings. Beyond salary stability, stablecoin payments can also reduce transaction fees and expedite payment processing, thereby streamlining payroll operations. By embracing stablecoin payroll, companies can attract tech-savvy talent and enhance their overall financial efficiency. Strategy's journey in the cryptocurrency domain offers valuable lessons for emerging fintech startups. Securing expert legal advice from the outset is non-negotiable for navigating the complex regulatory terrain. Startups must remain agile, anticipating and adapting to regulatory changes as enforcement priorities evolve. The risk of security misclassification, which can lead to substantial penalties, necessitates a deep understanding of these potential pitfalls. Robust cybersecurity measures are also essential for safeguarding digital asset management. By embedding compliance and risk management into their core strategy, fintech firms can build a solid foundation for sustained success in the competitive crypto market. In essence, Michael Saylor's continued conviction and Strategy's aggressive Bitcoin accumulation highlight a significant corporate trend, viewing Bitcoin as a strategic treasury asset. Yet, the path is fraught with challenges, including regulatory uncertainties and market volatility, demanding astute navigation. As stablecoin salaries gain traction, companies can effectively mitigate risks and optimize operations. The experiences of Strategy provide a vital blueprint for fintech startups, emphasizing the critical importance of compliance, proactive risk management, and strategic foresight in the dynamic cryptocurrency landscape. But what happens when the demand for this digital asset far outstrips what's being produced? We're about to reveal the staggering numbers. Bitcoin's supply race. Institutions outpace miners by 4x. In the ever-evolving world of digital finance, a compelling narrative is unfolding. Institutional investors and corporations are acquiring Bitcoin at a pace that dwarfs new supply from miners. A recent report from River, a prominent Bitcoin financial services company, reveals that in 2025, daily purchases by businesses and institutional entities significantly exceeded mining output. Specifically, private businesses and public companies collectively absorbed an average of 1,755 BTC per day, while governments added another 39 BTC daily. Complementing this, Bitcoin ETFs facilitated the acquisition of an additional 1,430 BTC each day, painting a clear picture of escalating institutional demand. This surge in demand contrasts sharply with Bitcoin's daily mining production, which remains relatively stable at approximately 450 new BTC per day. This stark imbalance between acquisition rates and new supply is raising alarms about a potential supply shock. Compounding this issue, data from CryptoQuant indicates that Bitcoin reserves held on exchanges have plummeted to multi-year lows. This trend signifies a substantial shift, with more Bitcoin moving from exchange platforms into the secure vaults of institutional treasuries and long-term storage solutions. Companies that hold Bitcoin on their balance sheets, often referred to as Bitcoin treasury companies, have become significant players in this accumulation trend. In the second quarter of 2025 alone, these entities acquired an impressive 159,107 BTC, pushing the total Bitcoin holdings by businesses to roughly 1.3 million BTC. Leading this charge is Michael Saylor's Strategy, which maintains the largest known corporate Bitcoin reserve, currently standing at 632,457 BTC. Industry analysts have noted that Strategy's consistent accumulation strategy effectively reduces the circulating supply of Bitcoin, mirroring the impact of a halving event by tightening availability. Shirish Jajodia, Strategy's corporate treasury officer, has clarified the mechanics of their large-scale acquisitions. He explained that these purchases are executed through over-the-counter, OTC, transactions, a method designed to minimize direct impact on spot market prices. Jajodia highlighted that Strategy strategically spreads its purchases over extended periods and in substantial volumes, a practice aimed at mitigating short-term market volatility. Bitcoin's trading volume is over $50 billion in any 24 hours. That's huge volume, he stated, emphasizing that even a $1 billion purchase spread over several days is unlikely to cause significant market price movements. The growing institutional appetite for Bitcoin is further bolstered by underlying structural market trends. On-chain metrics consistently show a decline in exchange reserves since early 2024, indicating a clear move towards cold storage and long-term holding patterns. Moreover, the burgeoning Bitcoin spot ETFs now collectively hold over 1.3 million BTC, effectively removing a substantial amount of liquidity from exchange order books. This reduction in readily available Bitcoin supply coincides with a notable decrease in the network value to transaction (NVT) ratio, which has fallen by 23% to 23.7. This metric suggests a healthier network activity relative to Bitcoin's overall market capitalization, signaling growing utility and adoption. While the potential for short-term price volatility remains a persistent concern for many, analysts are increasingly pointing to the long-term bullish implications of this constrained Bitcoin supply. Some market observers are drawing parallels between the current market dynamics and historical consolidation phases, such as the period preceding Bitcoin's significant rally in 2017. The convergence of tightening supply, favorable macroeconomic conditions like potential Federal Reserve rate cuts, and the innovative development of Bitcoin-native decentralized finance, BTCFI applications could collectively reinforce Bitcoin's position as a robust store of value and a foundational element of future financial infrastructure. But as institutions pile in, what's on the horizon for other digital assets, and how should you position yourself for the year ahead? The imminent 2025 altcoin breakout and institutional shifts post-Bitcoin halving, a strategic guide to high-conviction opportunities. As the cryptocurrency market continues its dynamic evolution, all eyes are turning towards the potential for a significant altcoin breakout in 2025. This anticipated surge is closely tied to the broader institutional shifts occurring in the wake of the recent Bitcoin halving event. For investors seeking to capitalize on these trends, a strategic approach focused on high-conviction opportunities is paramount. Understanding the interplay between Bitcoin's reduced supply dynamics and the increasing institutional adoption of digital assets provides a crucial roadmap for navigating the upcoming market cycles. The Bitcoin halving, a programmed event that reduces the reward for mining new blocks by half, has historically acted as a catalyst for increased scarcity and, subsequently, price appreciation. With each halving, the rate at which new Bitcoins enter circulation decreases, potentially creating upward pressure on its price due to supply constraints. This event often triggers a ripple effect across the crypto market, drawing greater attention and capital towards other digital assets, commonly known as altcoins. Following the halving, a notable trend has been the increasing engagement of institutional investors with the cryptocurrency space. This includes significant inflows into Bitcoin ETFs, as well as growing interest in a wider array of digital assets. As institutions become more comfortable with the crypto market's infrastructure and regulatory frameworks, they are increasingly exploring opportunities beyond Bitcoin. This institutional embrace can provide the liquidity and validation needed for altcoins to experience substantial growth. Identifying high-conviction opportunities within the altcoin market requires a deep dive into project fundamentals, technological innovation, adoption rates, and the strength of their respective ecosystems. Investors are advised to look for altcoins that solve real-world problems, possess strong development teams, have clear tokenomics, and demonstrate active community engagement. Projects focusing on areas such as decentralized finance, DeFi, non-fungible tokens, NFTs, Layer 2 scaling solutions, and interoperability are often considered prime candidates for future growth. Furthermore, the strategic allocation of capital becomes critical in this environment. Diversification across a carefully selected basket of altcoins can help mitigate risk while maximizing exposure to potential upside. It's essential to conduct thorough due diligence, understand the specific use cases and competitive advantages of each altcoin, and remain aware of the inherent volatility associated with these assets. Staying informed about regulatory developments and macroeconomic factors that could influence the broader market sentiment is also crucial for making informed investment decisions. As the market matures, the distinction between speculative assets and valuable technological platforms becomes clearer. The post-halving period, coupled with escalating institutional interest, presents a unique window of opportunity for discerning investors to identify and invest in altcoins that have the potential for significant long-term growth. A well-researched and strategically executed investment plan will be key to navigating this exciting phase in the cryptocurrency market. But while some are looking to the future, others are facing the harsh consequences of past crypto crimes. We're heading to India for a story of justice served. Indian court sentences 14 to life in major Bitcoin extortion case. In a landmark decision that sends a stern message across the digital asset landscape, an Indian court has handed down life sentences to 14 individuals, including police officers and a former politician, for their involvement in a brazen Bitcoin extortion scheme. The conviction stems from a 2018 case where a businessman was kidnapped, held captive, and coerced into handing over his cryptocurrency. This high-profile case not only underscores the escalating risks associated with cryptocurrency-related crimes, but also exposes deep-seated corruption within law enforcement agencies. The victim, Shailesh Bhatt, a businessman from Surat, had reportedly recovered a significant amount of Bitcoin from the collapsed BitConnect investment scheme, a notorious Ponzi operation that defrauded thousands of investors. Learning of Bhatt's recovered assets, a group of corrupt officials, along with associates, orchestrated a plan to seize the cryptocurrency. On February 11, 2018, Bhatt was lured to a gas station under the pretense of an investigation by individuals posing as agents from the Central Bureau of Investigation. He was subsequently kidnapped and taken to a farmhouse near Gandhinagar, where he was held against his will. During his detention, Bhatt was subjected to physical abuse and threats until he confessed to possessing 752 Bitcoin, which he had acquired from BitConnect developer Dhaval Mavani. He disclosed that 176 of these Bitcoin were held by his business partner, Kirit Paladia, while the remainder had already been sold for approximately $5 million. The perpetrators initially demanded all 176 Bitcoin plus a substantial sum of 32 crore rupees, roughly $3.6 million, in cash. When negotiations faltered, they resorted to extorting 34 Bitcoin from his partner's wallet, netting around $150,000. Following his release, Bhatt lodged a complaint with India's Union Home Ministry, triggering a comprehensive criminal investigation by Gujarat's Crime Investigation Department, which led to 15 arrests. The prosecution amassed a formidable case, presenting evidence from 173 witnesses, including digital forensics experts and banking officials who traced fund transfers. Notably, some police constables testified against their former colleagues, highlighting internal dissent against the corrupt practices. However, the trial was not without its challenges. A significant hurdle arose when 92 witnesses turned hostile, recanting or altering their testimonies, raising serious concerns about witness tampering and attempts to obstruct justice. In response to the perjury, Judge B.B. Jadhav issued notices to 25 witnesses. Despite these difficulties, the prosecution successfully established the conspiracy through compelling witness accounts and digital transaction records. Among the convicted were senior law enforcement officials, including former Amreli District Police Chief Jagdish Patel, a respected IPS officer, and ex-politician Nalin Katadia, who had previously represented the Dari constituency in Gujarat's Legislative Assembly. All 11 police officers were found guilty under India's Prevention of Corruption Act for abusing their public office, with the court emphasizing that such misconduct warrants the most severe penalties. Kadadia, who had been a fugitive for several months, received a life sentence, marking a significant legal consequence for his involvement in corruption. The court also ordered the confiscation of gold jewelry valued at approximately 2.4 crore rupees, $290,000, seized from former police chief Patel, to be processed by Mumbai's Master of Mint. In a complex turn of events, Shailesh Bhatt himself faces criminal charges. He was arrested by India's Enforcement Directorate in August 2024 for allegedly kidnapping 2 BitConnect promoters and extorting a substantial amount of cryptocurrency, including 2,091 Bitcoin and 11,000 Litecoin. This revelation suggests Bhatt may have been involved in his own illicit activities while attempting to recover his BitConnect losses. This case serves as a stark illustration of the intricate web of cryptocurrency-related crimes that emerged in the aftermath of BitConnect's collapse. The life sentences imposed on the convicted officials send an unambiguous message that courts will prosecute crypto-related kidnapping and extortion with the utmost severity, particularly when corrupt officials are involved. This verdict also demonstrates the resilience of the justice system against witness intimidation and corruption attempts, affirming that justice can prevail even in the face of significant obstacles. And that's a wrap on today's top stories. But before you go, let's do a quick lightning round recap of everything we covered. All right, crypto enthusiasts, that was a whirlwind tour of the latest market movers and shakers. We saw Michael Saylor doubling down on Bitcoin's value. Institutions are buying Bitcoin 4 times faster than miners can produce it. We explored the potential for a massive altcoin breakout next year. And justice has been served in a major Indian Bitcoin extortion case. Don't miss out on any of these crucial updates. Make sure you're subscribed, hit that notification bell like this video, and follow us on all our social channels so you stay ahead of the curve. We'll see you in the next one.